Welcome back, everyone. Next, we have Harbour Group Corporation. It trades on the New York Stock Exchange American under the symbol SKYH and is an aviation infrastructure company developing the first nationwide network of home basing campuses for business aircraft. Please welcome founder and CEO Tal Keinan. Welcome, Tal.
Thank you, Anna. Good to be with you all today. So I'm going to run through some slides in relatively quick succession and leave time for questions at the end. So feel free to get more granular as we go, but I'm intentionally going to keep this relatively high level on the first run through. We view ourselves as a specialty real estate platform. So we develop campuses like you see in the picture. That is our Nashville International Airport campus of what we call home bases. Right? And if people are familiar with the FBO, or fixed base operator industry in aviation, you can conceive of FBOs as hotels for business aircraft. You can think of Sky Harbor or a home base as a home for business aircraft, meaning we don't cater to transient traffic. We're not in the fuel business, right? Which is the FBO's core business. We are in the real estate business. And what we'll try to demonstrate in this presentation is some very robust returns on the project level that I think are significantly more robust than you'd see in most real estate development platforms. Some very deep competitive moats around the business, relative resilience in the face of the economic cycle, some real scalability. You know, we have 14 airport ground leases today. We think there are several hundred that suit our model. Our ambition is to get to 50 of those. So it's significant scale in the business, and some upside optionality beyond the real estate that we've already begun to capture, but we think we're early days on this. So by way of introduction, and I see Francisco has now joined us, I'll just ask us each to introduce ourselves. I grew up in military aviation, like a lot of the company, got into, after the military, into the asset management hedge fund industry, was able to purchase an aircraft in 2015, living in the New York area, and came across what was obvious to many people in aviation, but not to me, which is the scarcity of business aviation hangar capacity, which appeared to be a kind of a curious New York phenomenon. It quickly became evident that it's not New York, it's most major metro centers in the United States. And it is not only a longstanding deficit of hangar capacity, but it's growing more acute in ways that I'll show in a few minutes. So kind of to cut a few years forward, this kind of lingered as a curiosity until it became clear that there's a real business opportunity to approach this deficit in a way that the current aviation industry does not do. Again, we'll tell you that story in the coming slides. Francisco?
Yes, thank you, Tal. Francisco Gonzalez, CFO at Sky Harbor, a background in banking and transportation. And the key item that we brought to this business model is our ability to borrow with municipal tax-exempt debt, with significant leverage and permanent long-term bonds. These hangar campuses all over the U.S. And we'll talk about what that does to unit economics shortly in the presentation. Tim?
Yeah, good morning. Tim Hurd. I've been with Sky Harbor since the beginning in 2018. Started my career as a Navy pilot, and joined Tal after going to business school following the Navy, and been with the company ever since.
All right, thanks, guys. So jumping ahead, conceptually, the business is very simple. If you look at the red bubbles here, we secure land at airports around the country, develop campuses of private hangars with the attendant infrastructure, which includes ramp, fuel farms, and everything that you need to conduct aviation with an airworthy aircraft out of that campus. Then we lease them out to high credit tenants on a long-term basis and manage them. That is the business. What you're seeing in the picture on the right is our Houston campus that So you might recognize the Chevron Corporation, which is our anchor tenant in Houston. That's what the offering looks like physically. Our goals, as I alluded to earlier, we're looking to get mid-teens stabilized yield on cost, and we've demonstrated that already in the first projects, which translates after leverage to a return on equity in the 30s. We're looking to do that on more than 50 airports. And although, as far as we know, we're the only player in our space to date, we don't expect that to be the case forever. So I don't think we're going to be a monopoly here, but we do intend to remain the leading home basing solution provider in the United States. And we do think there's a significant first mover advantage in this space, and that there's just a lot of things that have to be gotten right. And there are gestation periods. There are seeds that have to be planted, in some cases several years in advance in order to move the business forward. So we believe that, and again, we'll get into those if there's time as well. The team, you've met us. I think we're more or less representative. Again, you can go on our website if you'd like to get into more detail. Jumping to, and again, these are all pictures from the various campuses. Jumping through the fundamental market opportunity. So it's a non-controversial statement in aviation to say that there is a chronic deficit of business aviation hangar capacity around the country. So I'm not even going to substantiate that. I don't think there's anybody, any professional in the aviation space who would disagree with that statement. What we want to show here, though, is the pace at which that problem or that deficit is becoming more acute, which is quite extreme. So in the decade leading up to COVID-19, the U.S. business aviation fleet added approximately 30 million square feet of airplane. Now, as far as I know, we're the only people who measure square footage of airplane, because it is the proxy for demand in our business. Right? We care less about the number of airplanes. We care more about the number of airplanes times the length times the wingspan, the total square footage of the fleet. That approximately 30 million square feet is new entrants to the fleet minus retirements from the fleet. So it is net. That's been the growth in the fleet. What's important also is more than half of that, 16.5 million square feet, belongs to an aircraft that has a tail height that's greater than 24 feet. The reason that's important is that much of the installed base of business aviation hangar in the United States has a door threshold height of 24 feet, because when those hangars were built several decades ago, that accommodated the tallest business jets. What you're seeing today is, again, more than half of the inventory that's been added to the fleet over the last 10 years physically does not fit into much of the hangar inventory. That's the niche that's most attractive. That's kind of the heart of the Sky Harbor envelope. And on the supply side, what we'll say is, first of all, hangar square footage is lagging. The pace of development of hangar square footage is lagging fleet growth by a full order of magnitude. That obscures an even more interesting note, is that hangar square footage in kind of rural or less developed parts of the country is more or less irrelevant, right? What's interesting is what's going on around New York City, what's going on around Boston, Los Angeles. Those are the critical areas where, again, the supply-demand mismatch is not only the highest, it's growing the fastest. The only thing I'll say on this as well is you can't really build a new airport, right? Where there's room for an airport, there's no need. Where there's need for an airport, there's no room. So we are pretty much tapped out. This is the supply of land for aviation that we're going to have. There will be other claimants of that land coming forward, right? So the kind of electric aviation industry and all of that, logistics, there are a lot more users of land in we think 10 years from now than there are today. But we believe that land is finite. So to that extent, we regard it as beachfront property. So how do we actually do it? So the pillars of the business, as I described earlier, is acquire the land, develop it, lease it up, manage it. The site acquisition is probably the most proprietary and unique thing we do. And that, one of the things that it took us a little while to discover is that we're really the only people who operate this way on a national basis. which is at our initiative, go out and source land on airports. The closest thing we have to competition, or and this is an industry that we also cooperate with quite significantly, is the FBO industry, which is dominated by two players, Signature and Atlantic, whose growth strategy over the years has really been mergers and acquisitions. So acquiring, one-off or small chains of FBOs. That's how they grow primarily. We grow through greenfield development. We're looking for raw land, not to acquire existing businesses. And again, it took us a while to understand this, but this is a methodology which is part art, part science, that we had to develop ourselves. And we do things proprietary. It's the biggest part of our team. It's the core piece. It's the binary unlocking of value in our business. We could build more efficiently. We could lease at higher rates. These are all good things for the business, but without the land, there is no business. This is the core. So the 14 sites that we have in the country are shown on the right. The most recently announced site is Salt Lake City. That's number 14. Stay tuned for more announcements, because we were, as I talked about planting seeds, we've planted many, many seeds across the country, and these will blossom in due time. But we have some that are, we believe, are imminent. Let me pass it to Francisco to talk a little bit about the economics, both on the unit level and the roll-up level.
Thank you, Tal. Very succinctly here. We're in growth mode, and we're capital intensive. So, which means that as we grow and convert these ground leases that Tal mentioned into hangar campuses, we use equity, and we use significant amounts of tax-exempt long-term bonds, private activity bonds, as shown here. Our, as Tal mentioned, our unlevered yield on cost are in the teens. And what we do is we pair that NOI with this amount of leverage, and results in unit economics of returns on equity in the 30s. As we grow, we're going to be more efficient in terms of our debt program. That's what we expect in terms of higher leverage and lower cost. We are going to seek investment grade ratings on our bonds in the coming months, in 2025. And with that should come at a benefit to our equity holders. Next slide. This is a little bit of our history. If you're looking at our company, you have to really be forward-looking in terms of all the projects that we have under construction and under entitlement and permitting and so on. If not, you're missing the whole picture. But it's good to know that on a consolidated basis, we are going to be cash flow positive a year from this time, when on the back of the opening of the 3 campuses in Dallas, Phoenix, and Denver in the first quarter. And once those get leased up, that cash flow and the existing cash flow of the 4 operating campuses will be sufficient to cover our SG&A, which will take us into positive territory. Obviously, we will continue to need additional capital for growth, but not to cover our operating expenses. Next slide. Back to Tal. On our target stabilized revenue levels as we sign ground leases.
Yep, thanks, Francisco. So this is a chart that I actually keep in front of my desk, because fundamentally, as we grow value in the business, this to me is the starting point for value creation. If I were to value this business myself, I would actually start with this, which is, what is the revenue capture in place today? So that is the square footage of hangar we can build on ground leases that are currently executed, that we currently hold, times what we call the Sky Harbor equivalent rent, which is essentially a measure of what aircraft are currently paying on those airports to base, what owners are currently paying to base an aircraft on those airports. So once I had that number, which right now stands at about a little over $120 million annually, I would discount that for various types of risk. Right? We do have development risk, we have lease up risk, we have operational risk afterwards, You also have to discount it for time. We don't set up these sites overnight, but those are coefficients that I would attach to a fundamental value-creating premise of what is the available revenue from these sites. I would also argue, and we always want to be conservative in our forecasts. We use Sky Harbor equivalent rent, although on the campuses that we're currently operating, we're able to charge much more. So our revenues are much higher than the Sky Harbor equivalent rents would suggest. Really by tens of percent higher. So we believe this is a conservative estimate, but this is where I would start. There are additional revenue streams that, when we started, we were really pure real estate, and we understand that there's more to it, and that's both. There's more to it if you want to maximize the value that's delivered to your residents, which we do, but there are also opportunities to capture revenues. So I won't go through all of these. I'll say that we've implemented fuel, and we're in the process of implementing several more as we speak. So more to come on that. In any of the projections that we've shown out, we don't actually count these, but as they actually become recurring revenue streams, we'll begin to integrate those. Back to Francisco.
Tim?
I'll actually cover this, Tal. So we have about 150 million in cash right now. So we have plenty of liquidity, and our first 6 airfields are fully funded with kind of airfields 7 through 14 funded with cash at the operating company level, and cash soon to be coming to the company in the form of a PIPE, which we'll talk about in the next slide. So very plenty of liquidity at the company level. Our bond debt service, as Francisco mentioned, is highly attractive as well, and we'll be looking to issue further debt in the future to fund our construction. Okay.
In terms of the recent PIPE, you saw an announcement a week ago. The company decided to, announce the $63 million PIPE offering that came from some of our existing investors that are led by existing investors from the last PIPE. And this $63 million will pair with excess cash that we have, plus the incremental debt that we mentioned we'll be issuing, and that will give us sufficient capital for the next 6 or 7 phase ones in these ground leases that are now in permitting and entitlement out there that Tal mentioned. Next slide. I think with that, we conclude our prepared remarks, and we want to open it to questions from the audience.
Great job, gentlemen. Yes, a question a little bit about the real estate. Elena wants you to go a little bit more into that. What do you look for specifically when you acquire real estate? Talk a little bit about the airports. Is it international, municipal, government airports?
Great, thanks, Anna. So let's start with this. When we validate an airport, we're still at a phase where we are 100% empirical. We're not speculative at all, right? There are airports that we can see a growth trajectory at that airport, and it in many cases we have high conviction that airport will be a winner and qualify for our portfolio in 3 to 5 years. We don't do those today. It's only airports that are firing on all cylinders today that we can actually make our numbers work today. Because there's so many of them, right? There's so much low-hanging fruit. We do intend to circle back to those growth airports down the road. In terms of, kind of the breakdown of the types of airports. So again, it's entirely empirical. It's not like we have a rule that says, we can only be on commercial airports or, right? So I would say the breakout has been, remember, there are 489 designated commercial airports in the United States. And there are another 3,000 federally funded general aviation airports, right? So think LaGuardia as a commercial airport, Teterboro as a general aviation airport. Our portfolio right now, I think, is roughly half and half, right? So Miami Opa-lawka is a general aviation airport. Nashville International is a commercial airport, and that you kind of go through the list. So there's no real rule on that. It tends to be the business aviation airports of choice for each metro center. There are metro centers that warrant multiple airports. In some cases up to a dozen airports that we would do in the same metro center. But again, it's not that we're saying it would only be commercial or only general aviation airports. I would even say, again, 100% of the airports that we're on now are federally funded. They're members of what's called the Airport Improvement Program, which is administered by the FAA. But that doesn't have to be the case, right? We could look at airports that are outside the program as well.
Thank you for that. And so given the rise in private aviation since the pandemic, how is Sky Harbour positioning itself to capitalize on this trend? Talk a little bit about your company's plan to ensure the long-term growth in this sector.
Yeah, so I'll say two things on that. One is a follow-up to that recession resilience claim that we made at the beginning, is that the FBO model is driven by fuel sales, which can be extremely lucrative. Right? Those are great. They're great businesses. However, they're cyclical. In that fuel is the first lever you pull as an aircraft owner in the event of a recession, pandemic, whatever it might be. So you can fly less and manage your expenses that way. So that's a pretty cyclical business. Our business is driven by rent, long-term rent with high credit tenants who tend to honor their contracts. Once an airplane is born, it has to live somewhere. So we think that the demand for what we're providing is far less cyclical than what you're seeing there. COVID-19, as Anna, you kind of alluded to, has driven a lot of people and a lot of businesses from commercial aviation into private aviation. And you can see that in the OEM backlogs, which are historically long right now. And airplanes are also getting bigger at a faster rate. Our view is once those airplanes are delivered, that demand is really locked in. It's not so cyclical. The second thing I'd say on that is we've positioned ourselves, and I think the industry is beginning to view us on a national basis. I think at the beginning we may have been a sort of a brand in Nashville or in Houston, but we weren't really on a national level. We are becoming that among the top flight departments in the country. And what we've seen happen is, your choices, you can live at the hotel, right? And most airplanes do live at an FBO in what's called a community hangar, where they're parked with a lot of other aircraft, including transients, where they're moving in and out. Just going to give you some slides of what kind of crowded FBO spaces look like. What we found is both of the FBO Duopoly, Signature and Atlantic, in the last 3 years have both been acquired by private equity. They were both public. Signature is owned by Blackstone and GIP and Cascade, and Atlantic is owned by KKR, who have done, I think what is very rational for that type of owner to do, which is make those businesses extremely efficient, basically on the basis that they dominate. If you go to Nashville International and you need to fuel, you have to go to either Signature or Atlantic. That's the only two options on the field, which is the case in much of the country, many of the key airports in the country. They have begun rationalizing and cutting OpEx, which is fine for the large fleet operators like NetJets, but it is driving some of the I'll call it the highest end of business aviation to Sky Harbour, in that we have a much more refined offering, which can be measured in terms of time to wheels up, right? If you're flying a $60 million aircraft, you really want to maximize the utility of that aircraft. So there's no such thing as waiting for service at Sky Harbour. Privacy, security, there are a lot of factors that come in that, again, have been accentuated by the sort of rationalization programs that are going on at the FBOs right now.
And Keinan asks, are there plans to expand to other aspects like fuel and other services outside of the real estate?
Yeah, so we currently offer fuel. We didn't really view it as a revenue item initially. It was more something that we just need to be able to provide at reasonable costs in order to help justify our rent premiums. what we've found is there's real opportunity to capture margin on fuel as well, and so we've done that. Again, we are primarily a real estate business, so this is kind of call it supplemental revenue, but we are driving revenue, and we're rolling out additional services. For example, again, we have many high-profile residents at our campuses. Providing security services to those residents has become, particularly in the current environment, has become a very sort of in-demand kind of service that I don't think FBOs can really provide it because they are open to the public. It's a and there's a lot of action, a lot of movement going on at an FBO. We really can control the volume of movement on our campuses, and it's very low. Which allows us to provide certain security services that others can't. And there's again, it's probably not fun to go through a whole list of them, but there are many such value-added services. We see them primarily as a way to bring differentiated value to our residents. That's really what we're looking to do here. But many of them, like the security services, also have a revenue component for the company.
Thank you for that. Charlie asks, what is the default rate, if any, in the long-term leases? And do the tenants have the right to sublease or sell them?
I don't think we have numbers exactly, but it's exceedingly low. Again, if you can imagine, these are owners of kind of the highest end aircraft in the country. So they tend to be good credits. Anna, what was the second part of the question?
Yeah, let me jump in if I may. There have been people who have come in and tell us, a couple of our tenants, hey, our plans changed. We know we signed a 3-year tenant lease. We want out. Unfortunately, there's no termination options in our leases. So we have done settlements with them and then release waited till we have a replacement and then release the space, basically being able to earn rent twice for the same space for a few months. So that has worked out nicely. So I think that's kind of like the answer to your question. Some tenants can sublease, but we try to keep that tight to make sure that the campus is the right level of activity. So it has to be with our consent.
Thank you. And last question from Keegan. What percentage of your business is individual owners versus jet fleet and charter companies? And how do you obtain more charter clients?
So the business is predominantly what's called FA Part 91 aircraft, which are aircraft that are not available for charter. They're owned either by a corporation or an individual. That's the vast majority of our business. We do have a few what I'd call high-end charter operators. It's not like NetJets. It's aircraft that that don't travel so extensively. They're primarily used by their owners, but are occasionally let out for charter. The reason we do, and we have a little bit of government as well. The reason we do that is, part of the appeal of Sky Harbor, part of the premium is these are very, very quiet campuses where, we can provide operating efficiency. Again, you can be as spontaneous as you want. If you call us and say, I need to take off in 45 minutes from a standing start, we can have you fueled and ready to go in 45 minutes on the busiest day of the year. That's something that's very easy for us to do. That's a little bit more difficult when you integrate charter. Secondly, it's the privacy and the security. The fact that our residents know that it's the same neighbors every day. There are no unauthorized personnel on the campus, including charter passengers, is I think a big piece of the value that many of the residents are looking for. So we're quite sparse on charter operator. Again, we don't work with the big network operators at all.
All right. Well, thank you, gentlemen. We are out of time. If you want to take a few moments just for some closing remarks, the floor is yours.
Yes, if I may, thank you, Anna. It's great to be in the Emerging Growth Conference, our first conference with this set of investors. Please visit us at www.skyharbor.group. We have a lot of information there on our past presentations. Also, if you have additional questions, please send them to investors@skyharbor.group, investors@skyharbor.group, and we'll be pleased to answer those. Again, thank you for participating in this conference and your interest in Sky Harbor.
Perfect. Thank you, gentlemen. We hope to have you back soon.
Thank you.
Thanks.
All right, everyone, stay with us. We'll be right back.